Hello friends, myself Mitesh Ajit Save and my presentation topic is function of RBI for the subject of financial regulations. Introduction. It is the Central Bank of India established on 1st April 1935 under the Reserve Bank of India Act. It has 22 regional offices, most of them in state capitals. Brief history. It was set up on the recommendations of the Hilton Young Commission. It was started as shareholders bank with a paid up capital of 5 crores. Initially, it was located in Kolkata. It moved to Mumbai in 1931. Initially, it was private, privately owned. Since nationalization in 1949, the Reserve Bank is fully owned by Government of India. Preamble. The preamble of the Reserve Bank of India describes the basic function of the Reserve Bank as to regulate the issue of banknote and keeping of reserve with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. Functions of RBI. First, issue of currency to ensure adequate quantity of suppliers of currency, notes and coins of good quality, issues new currency and destroy current currency and coins not fit for circulations. It has to keep in forms of gold and foreign securities as per security rules against notes and coins issue. Second, development role to develop the quality of banking system in India. Uh, Performs a wide range of promotional functions to support national objective to establish financial institutions of national importance, for example, NABARD, IDBI, etc. Anchor to the government performance all banking functions for the central and the state governments and also act as their banker existing that of Jammu and Kashmir. It makes loans and advance to the states and local authorities. It acts as advisor to the government on all monetary and banking matters. Banker to banks maintains banking account of all scheduled banks. RBI also regulates the opening installation of ATM. Fresh currency note for ATM are supplied by RBI. RBI regulates the opening of branch by banks. It ensures that all the NBFCs follow the Know Your Customer guidelines. The Reserve Bank of India also regulates the trade of gold. Currently, 17 Indian banks are involved in the trade of gold in India. RBI has invited applications from more banks for direct import of gold to curb in illegal trade in gold and increase competition in the market. Collection and publication of data. It issues guidelines and directive for the commercial banks. Role of RBI in inflation control. Inflation arises when the demand increase and there is a shortage of supply. There are two policies in the hands of the RBI: monetary policy and fiscal policy. Monetary policy, it includes the interest rate. When the bank increase the impact interest rate, then there is a reduction in the borrowers and people try to save more as the rate of interest has increased. Second, fiscal policy, it is related to direct tax and government spending. When direct tax increase and government spending increase, then the disposable income of the people reduce and hence the demand reduce. Formulate monetary policy, maintain price stability and ensuring adequate flow of credit in the economy. It formulates, implements, and monetary policy instrument, qualitative and quantitative. Quantitative measures, quantitative measures, bank rate are also called discount rate. It also includes repo rate, open market operations, buying and selling of government securities, variable reserve ratio. It includes CRR and SLR. Qualitative measures, direct action, moral precision, legislation, publicity. Bank rate, it's the interest rate that is charged by a country central bank on loans and advance to control money supply in the economic and the banking sector. This is typically done on a quarterly basis to control inflation and stability the country's exchange rate. A fluctuations in bank rate triggers a ripple effect as it impact every sector of a country economy. A change in bank rate affects customers as it influence prime interest rate for personal loans. Repo rate, whenever the banks have any shortage of funds, they can borrow it from the central bank. Repo rate is the rate at which our bank borrow currency from the central bank. A reduction in the repo rate will help banks to get money at a cheaper rate. When the repo rate increase, borrowing from the central bank become more expensive. In order to increase the liquidity in the market, the central bank does it. Reverse repo rate, it's the rate at which the banks park surplus funds with reserve bank, while the repo rate is the rate at which the banks borrow from the central bank. It is mostly done when there is surplus liquidity in the market by the market central bank. CRR, cash reserve ratio. Cash reserve ratio is the amount of cash that the bank have to keep with RBI. The ratio is basically to secure slowly of the bank and to drain out the excessive money from the bank. SLR, statutory liquidity ratio. It is the amount a commercial bank needs to maintain in the form of cash or gold or government approved securities before providing credit to its customers. SLR rate is determined and maintained by the RBI in order to control the expansion of bank credit. Manager of foreign exchange to facilitate external trade and payment and promote orderly development and maintenance of foreign exchange market in India. It acts as a custodian and manages the Foreign Exchange Management Act 1999. RBI buy and sell foreign currency to maintain the exchange rate of Indian rupee versus foreign currencies like the US dollar, euro, pound, and Japanese yen. Regulations of banking system. The prime duty of the Reserve Bank is to regulate the banking system of our country in such a way that the people of the country can trust in banking up to performance its duty. The Reserve Bank has following power in this regard. Licensing, according to the section 22 of the Banking Regulation Act, every bank has to obtain license from the Reserve Bank. The Reserve Bank issues such license only to those banks which fulfill condition of the bank. Management, section 10 of the Banking Regulation Act empower the Reserve Bank to change manager or director of any bank if it consider it necessary or desirable. Branch expansion, section 23 requires every bank to take prior permission from Reserve Bank to open new place of business in India. Power of inspection of India under Section 35. The Reserve Bank may inspect any bank and its book and accounts either at its own individual or at the instance of central government. Thank you.